On today's Breaking Views, currency devaluation, weapon or welcome byproduct? Well, that depends on who you ask, according to Breaking Views economics editor Edward Hadas. First of all, I think the theme of your piece on currency wars is essentially it's not worth fighting. I think there are several countries around the world who would beg to differ on that one.
Well, they would beg to differ in the sense that they're afraid that someone else is fighting a currency war. The Brazilians have been complaining, some Europeans have been complaining, and there are some countries, the governments, who feel that it's not a bad thing to have their currency value fall. It improves exports, hopefully makes imports more expensive and less attractive, and thus is a good thing, or at least...
So what's the problem?
The problem is, first of all, that the currency war is a poor image for what's really going on, because what's going on is a bunch of countries trying to kickstart their domestic economies. None of the countries involved, Japan, the US, the UK, are the governments, in none of these countries are the governments actually trying to reduce the currency value. It's a secondary effect. That's the byproduct idea. And the second thing is that if that were what they're doing, it's very dubious that it would have a huge economic positive effect, because what the studies show is that in developed countries, lower currency values tend to be dissipated very quickly, the gains from those currency values. And so there's just not much in it in terms of making your currency more competitive. It doesn't really do that much for the economy.
But with interest rate stimulus done, fiscal stimulus, I mean, for ideological reasons perhaps, nobody wants to go there. All that's left is some sort of competitive advantage or kick-starting, reigniting your economy via the exchange rate.
Well, if it were that easy, that is to say, if we could actually kick-start the economy via the interest rate, then perhaps that would be a good thing. Although even there you worry about the war problem, that everyone's trying the same thing. Then you get, as they say, beggar my neighbor policies. Mm-hmm. But the problem is that it doesn't even work that well. Now, I mean, Japan, it might work in the sense that Japanese yen has been extremely expensive. And the reduction we've seen in the last few weeks or last few months is basically a reduction to a more normal value. So that may actually help the Japanese economy. But the idea that if you devalue your currency or the market devalues it by 10–20%, that this changes the export position just doesn't seem to be true.
Well, the evidence of that is clearly the UK here.
Exactly. It had almost a 20% devaluation 2 or 3 years ago. And you could say, well, the trade position would have been worse if they hadn't done that. But in fact, it hasn't got much better from the case of the devaluation. But that's not the exception. That's much closer to the rule of the history of devaluations, especially in developed countries.
Isn't there a sense of, I mean, some countries in the emerging markets might think there's a sense of hypocrisy here. G7 essentially signs off on Japanese FX intervention. The Fed floods the market with trillions of dollars. The S&P has a peg for a couple of years. Yet the West lectures emerging markets not to talk about currency wars.
Well, yeah, the West is probably hypocritical. To be fair, though, the notion that developing countries can have undervalued exchange rates and that protects their growth is one that has gained some acceptance in the last few years, not just from economists but also from the IMF. So there seems to be a little bit more balance in this debate. But the one thing that I think is missing is a realistic appraisal of how effective currency devaluation is for stimulating growth. Not very.
Okay, just going back to Japan specifically, I mean, Japan's economic and regional neighbours are bound to be more than a bit miffed about the competitive disadvantage for their countries, especially in Beijing. I mean, I don't want to get too excited here or hyperbolic, but currency wars, you know, there's Japan, China, the islands dispute. China won't be looking upon Japan's economic policies too favourably. Well,
I think that the Chinese are willing to accept the recent devaluation, if you will, because they would agree with the Japanese that this is a reversal of an unfair revaluation. Now, if it goes on from here and the yen continues to weaken without inflation, then I think the Chinese will be upset. But I think that the situation in foreign currency markets is always upsetting someone, because you're letting these wild traders push currency values into extremes that aren't justified by the economic fundamentals. And this means you're always liable to political discontent from whatever the markets do.
Well, I think that's a conversation for another day. Edward, thank you very much. That was Reuters Breaking Views' Edward Hadas. And for more agenda-setting financial insight, watch our US Breaking Views show every day at 12:30 Eastern, 17:30 GMT. I'm Jamie McGeever. This is Reuters.